are excited to bring you to our first Credible Money Talk vote case. Today's topic is the impact of Forex reserves on currency strength. Our host for the vote case is Mr. Sudarao as Managing Partner of Trusted Capital, who has more than 25 years of experience in the world of finance. We also have Ms. Dian as Trusted Capital's Principal Valuer and Ms. Desi as Trusted Capital Senior Associate to dialogue with Mr. Sudarao on Forex Reserve.
Hello, Money! Welcome to our first episode of Credible Money Talks. This channel is dedicated to a series of talks on topics related to economics, finance, and investing. Today's topic is Forex reserves to GDP ratio. The question is, how much reserves are enough and what is the impact of such reserves? A country's Forex GDP ratio is critical in determining its economic growth. How is that? Well, if a country has a strong Forex to GDP ratio, first, the currency can be stable, and as a result of that, we would be able to attract foreign investors and this will result in capital inflows, and leading from capital inflows we would have higher GDP growth, because this means there's low risk for foreign investors and hence there would be better prospects for economic growth. Subsequently, due to heavy capital inflows, we would also enjoy an environment of lower borrowing rates, and this shall also further lead to more economic activities and leading to stronger GDP growth. In the world of treasury, there are basically three possible scenarios with regard to foreign exchange to GDP ratios. One is high Forex to GDP ratios in an environment where the country decides to trade its currency freely in the market. A second scenario could be where you have an average Forex to GDP ratio, but the country decides to have a controlled currency, meaning it's not as freely traded but relatively controlled. Or some countries may have an average to low Forex to GDP ratio and may also entertain a freely traded currency. So, for example, a country which has got a high Forex reserve to GDP ratio is a country like Singapore, and a country with an average Forex to GDP ratio is a country like India with a relatively controlled currency. On the other hand, we have Indonesia, which can be categorized into having an average to low Forex to GDP reserve, as we will later on see in the numbers, which you can see in the graph later on. So, what is the advantage of having a high Forex to GDP ratio? First, of course, it will allow for resilience against any external shocks or events in the environment, such as geopolitical tensions or in the past we experienced COVID or etc. These would relatively help to ensure resilience. And also further, we could expect some sort of economic stability due to capital inflows being stable, because investors always are feeling attracted to keep their money in the country and rather than move out when the currency depreciates. This will allow for a stability in currency, economic stability. And of course, this will further lead to more credibility with investors. So this will multiply into more capital inflows. And of course, all this means we will enjoy an environment of lower borrowing costs, and automatically the country is considered well prepared to meet its obligations, whether it's in terms of country debt or balance of payments, etc. So this could lead to some a consequence of stable economic growth, not necessarily strong economic growth, but it could relate to a stable economic growth. Now, the disadvantage of having a average or low Forex to GDP ratio is that the country is ill prepared in terms of earlier events or geopolitical events or such disasters. And of course, the country would experience capital inflows which are unstable, because capital will come in and then we'll have capital outflows whenever there's a significant depreciation. So this could lead to economic instability, and of course this means money is hard to come by, hence automatically we'll have higher borrowing costs, and subsequently all these do not help to translate into a strong economic environment or strong economic growth.
Okay, so from what you have mentioned, as far as I know, the foreign exchange reserve are a collection of foreign currencies and other assets that held by a country's central bank, which are used to facilitate the international transactions, maintain stability in domestic currency, and also manage various economic challenges. Now, we are wondering how a high forex reserve can mitigate a currency volatility and speculations.
Good question, Diane. So, if we look at the graph in this slide here, we would notice that Singapore has the highest Forex to GDP ratio overall in the entire period of the graph. And we can see that it's closely followed by Thailand, right? And even countries like Malaysia and the Philippines are not too far behind. And of course, India is on the average directions. And then we will see there Indonesia has always been trailing, right? So we see here that definitely the countries which are having strong Forex to GDP ratios are Singapore and Thailand. So one might expect that these two countries have a very stable currency. I mean, that would what one might translate that to. But in actual reality, we might see that in the next graph, currencies do depreciate and appreciate in time. So there is no perfectly stable straight line on any currency. So hence, then what's the advantage of having a strong Forex to GDP ratio? Now one might notice in this graph that despite the currency appreciation and depreciation that is true in the graph here, but countries like Singapore primarily always seem to be on an advantageous position, meaning that when the currencies depreciate, they are also following the curve in general, but their depreciation is the least relative to the other currencies. So they come out to look better. And then on the opposite side, if we see the appreciation of currencies in the graph, they always tend to also seem to appreciate more than the others in that period of time, and it's again coming out to be as a strong currency. So, a strong forex reserve to GDP ratio helps them to manage their currencies better, and with this advantageous position, they always tend to attract investors to ensure more capital inflows into their economies with this volatility, as being the country with a better stable return for investors relative to other countries. So that's the key point, right? So now, as we spoke about the three strategies earlier, right, where we know that Singapore and Thailand have a high forex to GDP ratio versus that of India, which is probably on the average. And if you look at Indonesia in the graph earlier, we noticed that they are on the average and low and always trailing behind. So this is not helping Indonesia primarily. Now, what does that mean? We know that currently Indonesia's currency has weakened and it's become the talk of town, and the rupiah has depreciated. And what this means is basically that we are going to have less capital inflows because of investors have basically lost a lot of money, because now their returns, if it's converted back to forex, is much lower, and hence that is not going to allow for capital inflows to be in a positive direction. So this is not going to be a positive scenario for trying to obtain higher GDP growth going forward.
In my conclusion, research can be used to stabilize the financial system, maintain investor confidence, and prevent abrupt currency collapses, which it will be a cushion against external shocks and economic crisis, right, sir?
Okay, good point. So the question is, what's the purpose of high forex to GDP ratio? Why should a country want to do that, apart from the points we discussed earlier? What's the core essence of such a policy? Well, the core essence of that policy is to ensure, let's say, if Indonesia is in the case in example, then Indonesia's government has a purpose to ensure purchasing power is effectively optimal for its population. So what happens when you have a average to low forex to the GDP ratio is your currency is at risk of depreciation, which is what has happened, and as a result we are going to have higher costs for cost of goods sold in Indonesia. As we know, most of the consumer products in Indonesia have a significant portion of import content. So now, with our rupiah depreciated, we have to spend more rupiah, right, to obtain our raw materials which are imported for consumer goods production. Hence, we have a higher cost of goods sold, and this will translate to leading to a higher price to the consumer, which of course will also translate into a sort of inflationary price for the economy. So these are not positive. So hence Indonesia's position with lower purchasing power because of the freely traded currency with low forex to GDP ratios would effectively mean that Indonesia's GDP growth is in question.
Since you mentioned about depreciation currency, now US dollar being the most used currency until now, And if you look at the exchange rate, it is getting more depreciated. In your opinion, what is the outlook for the US dollar in the future?
Excellent question, Diane. This is a question that is there in everybody's mind today. What is the future of the US dollar? Right? If you go back in history, one may note that before the US dollar, the currency that reigned strong as a global currency was the British pound. And as we know, the British Empire, as one used to say, the sun never sets on the British Empire, means the British Empire was so large, and nobody ever imagined that the British pound would not be the future global trade currency. But due to the World War II and Britain's position, which was significantly impacted by Nazi Germany's war campaign, depleted all their reserves, and hence the British pound became bankrupt, and fundamentally it shifted to the US dollar because, of course, the US was in a very strong position to provide arms and other requirements for the war campaign of Britain, etc. So hence they were the ones selling and transferred all the wealth from Britain to US, and as a result, the US dollar significantly gained ground and became the global traded currency. But we also should note that based on history, nothing is ever permanent. So one would expect in time that could be changes on this front of the US dollar being a globally traded currency. So now, what has happened? If we note in the US, over the last 10 years, the US purchasing power has significantly declined. What that means is the US dollar itself has also depreciated significantly. This we can note by looking at the interest rates, where 10 years or so ago we had the US dollar USD treasury rates were less than 1.5 to 2% at best, or even lower. But today it's above 4%, and this is astonishing. This is a multiplication of the numbers, and that was unacceptable a few years ago, but that's the norm. So why is the US dollar treasury rates going up? Is this because the US is loving to pay more interest to its investors? Absolutely not, because it's going to burn more cash for them, and of course they're not going to be interested to do that. But the reason they're providing such high interest rates is because the depreciating US dollar means similarly capital outflows from the US, and they would like to keep investors attracted by trying to maximize a return on their investment in the US, and hence they're trying to keep interest rates high to create some sort of stability to the US dollar. So if you want to pay such high interest rates, you have to generate cash, and that generation of cash should come from high GDP growth. So now the US is in a negative variance on this front. So when I say negative variance, means you have a very low GDP growth, which is about 1-2% at best, versus a 4+% treasury rate. So you have a negative variance on interest being paid versus GDP growth. This is going to burn capital in the US. But are they really burning their capital? No, they're not. They are in fact also printing more money to fulfill this interest payments, and as a result, it's depreciating the US dollar even further. And this is not good news for other countries who are using the US dollar as a globally traded currency, and so that's where it is. But going back to Forex reserves, as a follow-up of these trends in the US dollar, a lot of countries are switching their forex reserves, as one may call it, to become gold reserves, as they see the US dollar not being a stable currency relative to its past. So now it's considered relatively more unstable with the higher interest rates and more depreciation, etc. So a lot of countries are increasing their proportion of forex reserves to that of being in gold. So if you can see in the graph, we'll see here that in the graph on the left side, the US dollar is appreciating, and the graph on the opposite side, the Indonesian rupiah is depreciating. So what is this all about? So basically, you will see that the price of the US dollar, price of IDR per US dollar increases when there is a demand for USD on the left side. So that means if Indonesia buys something from other countries or imports something from other countries, there is a demand for US dollar that's created, and that demand results in a higher IDR to US dollar. And as a reverse translation, it leads to a lower demand of IDR in the Indonesian market, and hence that depreciates the rupiah. So this is fundamentally the core of economics in terms of demand supply. And so if this is not managed well, then this would lead to more depreciation, and that's where the purpose of a high forex reserve to GDP ratio comes into play. So Indonesia is sitting on a triple whammy, where one, we have a freely traded rupiah in the market, but this is based on balance of payments also, which are not positive, as one might see in this graph here. China has very strong positive balance of payments, and Singapore has kept itself clearly afloat in terms of balance of payments, and Thailand as well has somewhat kept it in a fair play. But if you see Indonesia, it's always more or less below the line, very rarely crossing the line. So hence, our balance of payments are not significantly strong, and that means that's pressure on the rupiah, and that is also what results in depreciation. And then if you look at budget deficit, so you see Indonesia is also a country which always has a deficit budget, and that means we're spending more than when we're earning. So when we're spending more than when we're earning, that means our rupiah is under pressure again. So now these three variables cannot lead to a stable currency. And if you look back on the interest rates, you see the consequence of this policy is that long-term interest rates, Indonesia is at 6.6%, very high, and look at Singapore, it's at 2.7, and look at Thailand at 2.7. So this is the consequence of Singapore and Thailand having a strong forex to GDP ratio, ensuring them to be in low interest rate environments versus that of Indonesia. But one may say, hey, what about India? India is at 7.2% interest rate, isn't that higher? But one may need to note that India is currently experiencing the highest GDP growth rate in the world, which is crossing 7 to 8%. So meaning they still have a positive variance from GDP growth rates to interest. So despite interest rates being high, it is fueling an economy which is moving forward at a very fast pace, and hence it can sustain that high interest rate, and you can see that their currency is relatively stable. Now, Indonesia, on the other hand, we have a 6.6% interest rate versus a growth rate of less than 5%. So hence, we are on a negative variance like that of the US. So hence, as we spoke earlier, the US dollar is depreciating because of those negative variance factors. Similarly, Indonesia also is on a negative variance, and hence this is going to put pressure on the US on the currency again to not have a stable rupiah, and this means investors are not excited, and so less capital inflows, and subsequently leads to not a very strong positive GDP growth.
As you said before, since Indonesia being in the lowest position that has a forex reserve to GDP ratio compared to other emerging countries, so do you have any advice for investors and stakeholders in making future decisions regarding this issue?
Excellent point for discussion. So what should investors do? Investors coming to Indonesia are going to have a long-term horizon. When I say long-term, that means it's above 10 years. It should be 10, 20, 30-year horizons. So a short-term and medium-term investors will be significantly affected with these volatilities in the currency due to Indonesia's weak Forex to GDP ratio. So what happens in the long term is basically, despite Indonesia's depreciation of the currency, in the long term, because Indonesia is a commodity-based economy, Indonesia also earns Forex and hence allows for some balancing in the depreciation of the rupiah, and this leads to overall, in the long term, a relatively managed cost versus the Forex. And hence, in the long term, Indonesia's investments in Indonesia relatively have higher profitability than that of its peers, and this allows for a decent return on investment for foreign investors, and hence foreign investors who are having a long-term play would be the one that would be encouraged to come into Indonesia. But this has a consequence. If this is the game that Indonesia wants to play, one needs to know, in the pool of investors who are in the group for long-term play are very limited, and hence this will curtail capital inflows significantly. So if we need to allow for short-term and medium-term investors to come in as well, the investment environment for the short term should be encouraging, meaning that we cannot have a depreciating currency in the short term, which is so volatile, to allow for low returns for investors. So my argument, based on all the above points that we discussed, to the new government is because we have a new president-elect, respectable Bapak Prabowo Subianto, or present to be brought into office in October. I noticed in his campaigns a very, very powerful phrase that he has used, and he has said, a statement that says, the strong will do what they can, and the weak shall suffer as they should. And he has eloquently detailed on how Indonesia should not be the weak and should move to become strong. But unfortunately, Indonesia is red marked on this issue of Forex reserve to GDP ratio. So we are nowhere in the category of strong, and hence one may need to rethink on this consequence of government policy with regards to Forex to GDP ratios. So now how do we go about it? Well, our recommendation is that the new government should rethink on the issue of balance of payments. So meaning we cannot have marginal positive balance of payments, or rather negative balance of payments. We have to have a policy which should have a clear surplus in balance of payments. One. Number two, we cannot afford to have a budget deficit at least in the first 2 years of office. So we must have a budget surplus. So these two elements, positive balance of payments and budget surplus, would lead to strengthening the coffers on Forex to reserves to GDP ratio. But this might disappear if we don't have strong currency controls. So we may need to add currency controls which are more significant to allow for retaining the Forex reserves to GDP ratio. Now, as a consequence, the performance of GDP in the short run may not be significantly strong. But we suggest that the new government better have a strategy for lower GDP performance in the first 2 years, but strengthen the fundamentals of the economic variables, and subsequently can enjoy a very stable and strong GDP growth with a stable Indonesian currency going forward into the medium and long term. And as a result, we would have a better purchasing power for the Indonesian people in the long run, and that would allow for voters to be more excited for bringing this government back in its second term. So thank you for watching, viewers, and hope this podcast was informative, interesting. If you want to read further on this topic, you can click on the link below where we have our newsletter called Credible, and you could participate in your by giving your comments, and who knows, these comments all put together could lead to a more concrete proposal or strategy for the new government to rethink its policies on economic development going forward. Thank you to my colleague Dian, and thank you Daisy for joining this podcast, and we wish you all the best. Adios.